welcome. Thanks very much for joining us. My name is Mark. I'm head of risk at APM Capital. I'm very, very pleased to be announcing this webinar, this third of three webinars that we've done in partnership with the CME Group, but also presented by Brannigan Barrett. For those of you who have missed the first two, Brannigan Barrett is founder of Habitus Capital, which is a boutique investment firm specializing in futures trading. He's got over a decade of experience of professional futures trading. He's also founded a company named Tradelo Trading, which is dedicated to developing innovative trading tools for retail traders. And Brannigan's got hundreds of hours of educational content on YouTube, which I recommend you have a look at. It's good stuff. With those introductions out of the way, I think I'll hand over to you, please, Brannigan.
Brilliant. Thank you very much, Mark, and good afternoon, everybody, and welcome to part 3 of this webinar series. Now, where we're going to start off with today is effectively our introduction, our objectives. We're going to go with our key trading principles, the same as the first 2 parts. We're going to talk predominantly today about position sizing and psychology around position sizing. We're then going to move on to the key market narratives. There's quite a few things happening. So really make sure we just cover those narratives, really understand what is moving the markets and where that opportunity scope is. Those opportunities we're going to discuss today will be in gold, so predominantly GC, as well as the S&P 500 ES. And we're also going to introduce ZT today, the US 2-year yields, and I'll explain to you why. It's a really important market for you to consider start trading, but I will explain to you why later on. And then we'll finish as per usual with a live Q&A. Now, the markets we cover, as I mentioned, we do cover the most liquid CME products during these webinars. And today's quote is, if you're not willing to take big smart bets, you will have to settle for ordinary returns. Now, I want to be real with you because I think that's been the purpose of these webinars, is really just to be honest, upfront, and holistic. 90% of a trader's returns will end up coming from 5% of all their trades. Okay, now, unless you're an algorithm, this is going to be your distribution curve. Now, most of your trades are going to get stopped out. That's just reality. But some of your trades will be home runs. Now, you don't need to bet the farm to be a successful trader, but you are going to have to step out of your comfort zone every now and again when the odds are in your favor. Okay, the reality is that trading is a boring job. Unfortunately, if you're coming into this for excitement, it's not the right job for you. This is a very boring job. But I'll tell you what, every now and again, the market's going to give you something that you understand well. It's going to give you something that structurally makes sense. You get a lot of confluence. And it's up to you to know what you need to do at that point in time so that you can go and capitalize on that moment. Now, the key principles we've covered over the 3 webinars, we started off talking about the key benefits of trading futures. We then moved on to a typical equity curve and what it looks like. We then spoke about daily stops and what that percentage looks like, and also how you can take more winners. Now, today's discussion is all about position sizing. It's all about risk management. And you'll understand why this is such a crucial topic. If anything, this is probably a 6-hour topic. It's something I have to condense for you into, sort of 20, 25 minutes. But it's a very extensive topic, and you'll understand why it's so crucially important. Now, what I want you to do is a little exercise after today is I want you to go away and I want you to just take a picture of these 3 questions or take a snapshot of it. But what I want you to do is I want you to go and write down for yourself, what are the 3 biggest trading problems you're currently experiencing? Okay, go write them down. You'll know what they are. All right, if you've been doing this for any amount of time, you'll be very aware of those big mistakes that you keep making. And what I want you then to go and do is I want you to rank them. Put them in order of what's costing you the most money and what's costing you the least money. And then finally, next to each line, I want you to go and place a dollar amount of how much you think it's costing you. Now, what you're going to find is that 90% of all your trading problems will always in some shape or form typically begin with risk management. And I think you'll understand that after today's session. You're going to look back and you're going to go, you know what, actually, yes, if I just think about stop in a predetermined way, then yes, this problem will disappear. If I just manage risk and the position sizing before entering, then I will never stay in a trade for too long or move my stops around. And what you're going to find is when you can predetermine risk, when you take care of risk management before you even put a trade live in the market, you're going to find that 90% of all your trading problems will just disappear. And that's what I want you to take. That's the key message I'm sending you today. It is the first skill I teach any trader I mentor. Okay, if you can learn basic risk management, you've got edge. Now, what you can understand on the next slide is why it is the most desirable skill to learn. Before I explain to you how you increase your position size methodically, I'm going to start by outlining for you one of the best practices you can adopt as a trader today, immediately. Okay. And this practice is to put risk management at the forefront of every decision you take. In other words, in basic English, before you go click that mouse and say, I want to buy the market, I want to sell the market, before you do that, you must determine your stop and where it goes, at which price you're placing it. And secondly, as a direct result of that stop, you need to determine exactly what the position size is. Everything is predetermined before you buy, before you sell. If you can adopt that process, if you can make it habitual, you will have got edge. Guaranteed you will have an edge. Now, we do not control what the market does, right? We only control where we place our stop and what position size we establish. And this is why it's so crucial we do it in a predetermined way, because we can control it. Now, there's 6 reasons why I want you to predetermine your risk management. The first one is stop placement, right? We need to objectively determine where we're going to place our stop. We place our stop where a trade is invalid. Now, what this requires us to do is it requires us to think about the stop we're going to be using, rather than just buy the market and then go, oh, maybe I put my stop below resistance or whatever it might mean. No, before we actually enter the trade, we're forced to think about where we are placing the stop, why we're placing the stop there. Moreover, the bigger the stop we're going to use, the smaller the position size we will be capable of using. So there's a direct relationship between how big a stop we use and the position size we can establish. And this ensures we don't over risk. Moreover, it ensures we prioritize placing stops where the trade is wrong. We don't choose a position size that can make us a lot of money. This is typical. I'm confident. I like the idea. Oh, I'm just going to go and use 5 lots in the S&P. No, we don't choose the position size. We choose the stop. We determine where we're going to place that stop, where the trade is invalid, where that trade is wrong. And the position size is calculated as a direct result of that stop size. And I'll go through this extensively today with you. Now, this is the key to the trading process. We make decisions that increase the odds of a trade succeeding. If we start to use too tight stops because we want to have a bigger position, the reality is more of our trades are going to get stopped out. If we use too big a stop, ultimately we're never going to make any money because our position sizes are going to be too small. So what this process does when we're thinking about stop placement before we actually enter the trade is it's ultimately ensuring that we entering trades optimally, we're placing stops optimally, because ultimately our position size is a direct result of that. Okay, so this is the first reason why we have to predetermine our risk management. Now, the second reason is all about risk reward. Okay, if we know where we're going to place our stop, so we've just said, look, I'm going to buy the S&P and I'm going to use a 40 price stop, so 10 handles. This directly enables us to assess the potential risk reward, because if I know I'm going to use 10 handles as stop because I think maybe it goes 20 handles of upside, immediately I've got an understanding of what the potential risk reward looks like. Okay, so because we can fix that stop, we can also start to assess practically or pragmatically what that trade-off looks like. Ultimately, then what we can start to say to ourselves is, well, hang on a sec, I'm risking 10 handles, but the S&P is volatile. I think the S&P is going back to record highs. That means I can make 150 handles. I can risk 10 handles. That's an absolute no-brainer risk-reward trade-off. Now, so long as I respect that stop, ultimately those kind of trades are the ones that will make me money in the long run. The third reason, dollar loss acceptance. Okay, and this is one of the most important benefits you'll gain from placing risk in a predetermined manner. Okay, if you determine where that stop goes, again, we come back to the 10 handle example. I know that if I'm going to use 10 handles, okay, and I'm going to use a 1 lot, ultimately it's going to cost me $425, $450. Okay, so ultimately I know what the cost of that trade going wrong is. Now, what that means ultimately is that I can accept that loss relative to the big picture. In other words, if I've got a $100,000 account and this trade's going to cost me $450, it's 0.45 of the account. It's a no-brainer. It's not even a consideration. It's not even a concern. Moreover, when I tie it to the fact that, well, hang on a sec, I'm going to spend $450 to potentially make, $4,500, again, I can accept that loss a lot easier because I've dollarized it. Okay, and this is very, very crucial. Because we're humans, because we buy things with money, we attach value to that money. $100 buys me X, Y, Z. Therefore, if I lose $100 on a trade, effectively I'm foregoing all that potential value. All right, so when we can dollarize it, when we can accept that dollar loss and sort of compartmentalize it for ourselves, it makes it easier to absorb the loss. The fourth reason, emotion-free. If you've accepted the loss before you've entered the trade, there is nothing to fear because, hey, my worst case scenario is $450. So what? I've got a $100,000 account, $450 doesn't matter in the big picture. So when we take control of risk, you eliminate uncertainty. What causes traders to be emotional is when the irrational side of the brain starts to take over. And we'll talk a little bit about psychology in a few slides' time. But our monkey brain starts to cause ripples and it starts to make something seem threatening to us. What happens? We get the natural flight or flight response because the reality is we will respond irrationally when we don't understand something, when we feel uncertain. Now, you don't ever want your emotions to make decisions for you because you will always make the worst possible decision. That's a fact. The fifth reason, overconfidence bias. Okay, the fifth reason is eliminating biases, right? Things like overconfidence, things like recency. These are two of the most common biases that traders exhibit. If we don't predetermine our position size, okay, so we don't know that we're going to use a 10 handle stop, we will effectively be driven by these two primary biases, overconfidence and recency bias. When we're confident, what's going to happen? We're naturally going to use bigger positions. Equally, we're naturally going to use wider stops because we feel invincible. We feel like we cannot do any wrong. Now, when we have just executed a trade idea well 3 times in a row, the reality is the 4th time that trade comes along, you're not going to use the same position size. All you're going to be thinking in your head is, hey, I've got something that just keeps working. The last 2 times I used a 1 lot. I need to use 3 lots this time, 4 lots this time. And that's when it starts to go wrong. Because what we do by using a bigger position size is we're making an assumption that the probabilities have changed when they haven't. Okay, so we suffer from that recency bias. Equally, what happens when we go, through a very bad run? So we've lost 3, 4, 5 days in a row. The reality is we'll suffer from that bias. Suddenly we'll start to use, very, very small stops because we're so afraid just to lose on another trade. Right? So when we determine risk in a predetermined manner, we will not suffer from our biases. And then finally, trading is a continuous flow state. And this is a crucial thing to understand. The price never stops moving, right? Now, obviously, they're talking about, making US markets, 24 hours a day in essence. The reality is that we have to be able to detach ourselves from the trades that we heavily invested in. Okay, you all know the perfect example. Let me give it to you. You faded a market. It went too far, too fast. We all know that trade. We've all done it before. Suddenly you go offside. You buy more because now it's done a 2 standard deviation move. So surely it's gone offsides more. So now it's gone way too far, right? And we average it down because we justify it to ourselves. Well, it went that far. That's why I bought it. Now it's gone even further. Now it's an even better buy. And it just keeps going. And the reality is eventually you're all in because now surely it's gone too far, too fast. And we all know how the story ends. When we have a position on, no matter how big or small it is, we are invested in that trade. Now, that means we cannot be 100% objective. It's just not possible. So in order to safeguard yourself from being sucked into this continuous flow state where the market's just continuously moving and you're incapable of moving from a subjective state into an objective state, to avoid that, we have to predetermine risk. Because what happens is when our stop gets triggered, it's suddenly a pause, which allows us to take a step back, remove ourselves from the continuous flow, become objective again. Sure, we can still be emotional and frustrated, but we can then reestablish objectivity before we go again. And that's absolutely crucial. If you're not predetermining risk, you will find yourself stuck in a continuous flow state. And that's why traders typically over trade. That's why traders typically eventually over risk. That's why traders suddenly tilt. It's because they get sucked into the continuous flow state of the market. And why? Well, because they're not establishing risk in a predetermined manner. You establish risk in a predetermined manner, you will not suffer from a continuous flow state anymore. If there is one skill you must adopt into your trading more than anything else, you've got to put risk management at the forefront of every single trade. If you can establish this habit, you will adopt an edge far more powerful than any strategy you will ever learn about. Now let's talk about position sizing. The position size you establish is a decision you are going to make 100 times a year, 1,000 times a year, hundreds of thousands times in your career. It is single-handedly the most important decision you make, and yet people don't automate it. They leave it to discretion, and yet it's far more important than any other decision, whether you buy or sell, whether the market you trade, whether the strategy you trade. The most important decision is establishing your position size, because you're going to do it hundreds and hundreds of thousands of times over. So it has to be optimal. It's important that you have a process to automate the position size calculation for you. You do not want to leave it to your own calculations. Have something that automatically does it for you. Now, last week, we spoke all about setting a daily stop. And the key takeaway was that a daily stop is determined by your account objectives. And ultimately, if you want those outlier returns, those really big updates, you're going to have to expose the account to a bigger potential drawdown. But importantly, I stress that most account objectives, most of you traders will be able to meet your objectives with a stop somewhere between 2 to 5%. Okay, so a daily stop, how much I'm willing to lose on any given day. Now, how do you increase your position size? You don't just do it randomly. Okay, that's important to establish. Most traders do it randomly. There is a methodology. In the next slide, I'm going to explain to you the importance of why you have to follow a method to increasing the size. Now, when I started trading back in 2011, this is how we did position sizing. Okay, we would start with a one lot, because back then there was no micros, there was only full contracts, and we had a 600-pound stop on the day, and we could only trade one because that's the minimum increment. Now, when we started making some money and we were a little bit confident, we went on to 2, eventually 4, eventually 10, and 100. That was the process. It was based purely on progression in some shape or form, account progression, maybe a little bit of momentum. Effectively, the steps taken were aligned to our recent performance. Remember that thing I said to you, recency bias. We were determining position sizes off of recency. Now, in theory, there is some sense to this, because effectively you're just risking your profits. And in exchange, you can grow an account quicker. Now, the problem with this approach is it only works for some traders, very few, in fact. It didn't work for me. My experience with this approach was I would get up to 30 lots. So I would progress with the account, and all of a sudden I would be trading 30 lots. I'd have 3 bad days in a row, lose all of the progress I made in 3 weeks, and then I'd have to be started all over again back to 3 lots. So I'd go from 3 to 10 to 20 to 30 and back to 3. Moreover, what happened when I made this very aggressive step up based on the recent results was my focus started shifting from process to suddenly tightening the stop, so I could avoid losing too much. Okay, and this is what happens, and we'll talk a little bit about this in the next couple of slides when we talk about psychology. But the reality is, when we expose ourselves to too big a position, we become irrational. And as a result of that irrationality, we are incapable of following a process, because the focus shifts away from, I put my stop here, I'm looking to get out here, and it moves towards, I'm losing 5,000, I want to get out because this is painful. Okay, so we move away from focusing on process and move towards output or results-oriented focus. Now, this is an important lesson in psychology, which we will talk about in the next couple of slides. But how should you increase the position size? What is the right way to go about it? Okay, it is definitely a byproduct of account size. Okay, and that's what I'm trying to illustrate to you. Our account balance is a crucial determinant in ultimately what position size we establish. But we must do it as a process over time with incremental steps based on objectivity, not our subjective feelings like, oh, I'm confident. Ooh, I made lots of money yesterday. Ooh, my recent results look good. It must never be based on feelings. It has to be purely objective. Now, let's go through a hypothetical example. This account balance has got $135,000 with a daily stop of 2%. In other words, on any given day, this trader can lose up to $2,700. Now, the process at this point, and this is coming back to what I told you on the previous slide, which is the skill you have to develop is, I want to do a trade today in the market called 6E, Euro Dollar FX. And I have the strategy called absorption zone, and I want to use a 20 pip stop. So I'm simply going to determine, and I gave you the two risk strategies in the past two sections, but I'm going to determine that with this 20 pip stop, what position size can I establish? And everything works backwards from that point. In other words, if, for example, I'm using just a straightforward equal weighted system on a risk daily basis, what it means is if I have $2,700 of risk and I do 5 trades a day, roughly speaking, I'm going to have $533 of risk. Okay, now what that means is I simply take the $533, I divide it by the 20 pip, and it will then output for me a position size. And that position size in this example is 5. Okay, everything works from the account balance to the daily stop to the stop size. All we do is we input, I want to use this stop size because that's where my trade strategy called absorption zone is invalid. And the rest is automatic. Now, let me show you the power behind this. If that number was not 135, but it was 165, okay, this 2% stays exactly the same. Let me change color pen here. So let's go to blue. So that 2% stays exactly the same, but that 2,700 is now perhaps something like $3,200, which means the $3,200 divided by the same 5 trades increases up to, call it $650, which means now with that same trade in the 6E, in the absorption zone, with the same stop size, suddenly now I get to use 6 lots. And again, if that account balance keeps increasing, that daily risk limit stays the same, but the amount, the dollar amount that I'm capable of risking increases, which means my risk keeps increasing. This is how I grow the position size. It's directly correlated to my account balance. Okay, it's not about, oh, what did I do yesterday, or how am I performing recently? No, it's a direct byproduct of the account balance. Now, what's important to understand here is that we control the daily risk limit. We determine how much we're going to risk on a daily basis. We also control the stop placement. These are the things we do control. So we need to make sure that we're optimal with them. Okay, this is the key takeaway, is we simply just automate what we can control because that enables us to be optimal with it. Okay, and like I said, our position size is a direct product of our account balance. But what you will notice, and this is why it has to be automated, this account balance will steadily increase. And what that means is the account balance may go from 135 to 140,000. But the reality is that even with that $5,000 increase, this risk position may still only be 5 lots. It's only when that account balance shifts by a specific amount that we will then step up incrementally to that 6 lot. Okay, notice we didn't go from 5 to 7, we went 5 to 6, and 6 to 7, and 7 to 8. And you'll understand psychologically why this matters on the next slide. Also, and this is key to understand, what happens when the account balance goes down? So let's say we go from 135 to 130. Well, the reality is we're not suddenly going to go from 5 to 1. This is what traders typically do. They have a bad day. Oh, I got stopped out yesterday. I'm too scared to trade my 5 lot. Now I want to trade 1 lot because it feels safe. And that's the mistake. We don't jump around our position sizing. We have to be consistent with it. Right? And that's the key to automatic risk management, is that when we go on a bad run, sure, maybe this risk does come down because we don't have that momentum. We're not trading well, but it goes from a 5 to a 4 and a 4 to a 3, not a 5 to a 1. And equally, when we're doing a well, not a 1 to a 10, right? It's the incremental approach to position sizing that matters most. Now, before we get to that point, let's talk a little bit about psychology. Oh, I've lost my psychology slide. Okay, my psychology slide's gone somewhere, but I'll talk you through it anyways. Okay, now, ultimately, I do need that psychology slide. I'm going to draw it for you. Sorry, I've actually lost my psychology slide. If you can just give me one moment, let me see where it's gone. Mr. Psychology slide, where are you? Okay, I seem to have deleted it. That's not good. Okay, let me actually just quickly create a slide here. And I'm just going to insert a slide and I'll draw it for you. Let's duplicate a slide and get rid of this. Okay, that's not working. But let me quickly just illustrate this for you. Okay, from a psychology standpoint, what I want you to do is I'm going to annotate a chart for you. Apologies for this. I actually did have a very nice chart. On the y-axis, we've got our rational level or our level of emotion. Okay. And on the x-axis, we have the number of lots. Okay? And how I want you to think of those number of lots is 1 all the way up to 50. Okay. And we have 3 zones, and this is crucial to understand. I'm going to illustrate these 3 zones with color. The first zone is this zone, yeah? And we call that our CZ, our comfort zone. This is where we are comfortable. Our psychology is comfortable, and I'll come back to the zones in a minute. The second zone is what we call the growth zone. And the third zone is ultimately our irrational zone, okay? Now, how it works typically with position sizing is when we work incrementally, so when we move up incrementally with our positions, we go from 1 to 2, 2 to 3. What happens is our psychology has got time to adjust to what we call a new normal, okay? In other words, if you do 50 trades and you do them all with a 1 lot, it's quite normal and familiar experience. You're used to it, okay? You're used to that, oh, when I lose on this 1 lot trade, I normally lose $100 to $150, okay? So your psychology accepts it. It's your comfort zone. Now, as our account is growing, from, for example, from 20,000 to 30,000, we suddenly start experiencing we're able to do 2 lots. So we make that little bit of a jump, okay? And ultimately, we do it incrementally. It's a gradual process. Because we're following a position size that's directly linked to the account balance, we're gradually increasing that position size. Now, sure, when your account's at 30K, some days you are still going to have a 1 lot, but you're going to start experiencing 2 lots and 3 lots because the account balance now suggests you should be using that position size. And what happens is we gradually exposing ourselves to what we call a new normal. Okay, but sure, the first time you experience a 3 lot, you are going to be nervous because in your head, you're doing 3 times 10 ticks means, oh, I'm going to lose $300. Normally, I only lose $250. So, of course, you're going to be a little bit maybe emotional if you lose a bigger amount than normal, but it's not a significant irrational type of emotional response. Okay. Now, what happens as the account continues to grow is eventually we get to a 4 lot. And this process continues. Now, what I always suggest to traders, and this is very important from a risk standpoint, that first slide with a quote I said to you, if you're not willing to apply yourself and take a bit of risk every now and again, the reality is you're always going to have to accept, sort of okay returns. You're never going to have the big up days if you don't take that risk every now and again. Now, what I mean by that is don't go crazy this afternoon and suddenly start using 50 lots when you normally use 5. That's not what I'm suggesting. What I'm suggesting is that every now and again, you as a trader have got to step out of your comfort zone. And I'll tell you why in a minute. Now, what I mean by stepping out of your comfort zone is when you have a trade where the odds are in your favor and your normal position size is 4 lot, don't be afraid to use a 6 lot. Don't be afraid to use an 8 lot. Okay, the important part is that it's within range of what is normal. In other words, if 4 lots is what's normal, a 6 lot is not that different to a 4 lot. The additional loss is also not that different. And what that means is that ultimately, sure, you're risking a little bit more, But what you gain from stepping out of your comfort zone is very, very important. And you'll only understand this fully once you experience it. But once you dip your toe into a six lot, something beautiful happens. What you realize is that there's no difference between 4, 6, 8, 100. They're all the same thing. The market can absorb that liquidity, and it's no different to the process. And this is the beautiful part about stepping out of your comfort zone, is you very quickly realize that, hey, 4 lots is no different to 6 lots. I can do 6 lot trades. I can do 8 lot trades. I can do 10 lot trades. And that's important because from your psychology standpoint, remember what I said to you, you have to ultimately make gradual steps higher. But to do that, every now and again, we need to push the boundary a little bit, push our psychology to say, look, I just want you to try the 6. I know you used to 4, but try the 6. See if you can handle it, because the more we do it, the more we try that 6, the easier the transition becomes into having 6 lots as a normal position. And this is how you deal with your psychology. Your psychology is fickle. If you suddenly went and traded a 20 lot today, okay, when normally your position size 4 lot, what ends up happening, and I'm going to illustrate the curve now, what ends up happening is we have a curve like a J hockey shape, which goes like this, okay? Because when we suddenly trade 20 lots compared to our normal 4, we do not understand the implications of that decision. We cannot compartmentalize the dollar loss of that decision. We cannot come to understand what will happen to our account as a result of that position. So we hit the 20 lots, we make a whole bunch of bad decisions, and then suddenly we have this massive loss. But it stems from the fact that the moment we use 20, our degree of emotion and irrational has gone through the roof. We will always react in an irrational way. And this is the key to understanding your psychology. You can do incremental changes. You can go from a 4 to a 6, and you will be completely rational and non-emotional. It's when you try and make those big leaps that your psychology says, nah, we're not going there. We're not ready for that. And we shouldn't be doing this. Get out of it. And that's when the monkey brain takes over. The monkey brain says, just exit the position. I don't want it. And that's when we rack up those significant losses. So the key takeaway, work with your psychology. Don't work against your psychology. If you know what your psychology is all about, you will understand that position sizing is done best when it's incremental as a byproduct of the account size growth. Okay. Let's now move on to our key market themes. We're going to start off and talk about Powell. He spoke yesterday. He said something interesting, and he told us that policy is restrictive. We're going to talk about BOJ. Okay, they are in the headlines. They're intervening. There's some trade opportunities there for you, but I just want you to be aware of how it works and what you need to watch out for. I want to talk a little bit about oil. Okay, it's a fantastic recessionary indicator. At some point, we're going to get a recession. Maybe this year, maybe not. Who knows? The point is, you need to know that oil will always signal out that recession for you quite early. And that's key ultimately because you can use it as a proxy market. And then finally, the wall of worry is over and the S&P is about to start climbing again. Okay, now let's talk a little bit about FOMC. Mr. Powell came out yesterday and he told us quite simply, I do think policy is restrictive and it's weighing on demand. He was asked, Mr. Powell, what do you think about recent inflation? Do you think perhaps maybe you need to hike more? And he simply pushed back and said, policy is restrictive. Policies weighing on demand, and you can see that in the labor market, and we saw it in the evidence in today's JOLT numbers. Quits and hiring rates have normalized, and what he told us is we've got a dual mandate. Sure, inflation is sticky. We acknowledged it. We updated our statement to acknowledge that inflation was sticky, but at the same time, we accept we'll allow inflation to get back to target only in 2026. And we've accepted that. We've communicated that already in the March meeting. We also want to let you know that we have a dual mandate. It's not just inflation, but it's also employment and full employment. Okay. And so he really said to the Hawks, I get what you're saying about inflation. I get that it's ticking up, but don't forget, if all of a sudden unemployment ticks up above 4%, we're going to begin the process of cutting rates because we have a dual mandate, not just an inflation mandate. This is important to stress because unfortunately, social media weighs in only on one side of the equation, which is inflation's ticking up, they must hike more, interest rates are going to go up. It's not quite the case, and this is why we have to listen very closely to what the central bankers are telling us. Okay, now, He went on to say, we believe that over time, policy just needs to be held higher. What the Fed is thinking is we'll just keep interest rates where they are for now. And at some point, we think that will be enough to bring inflation back towards its target. Now, one thing I want to stress, and this is a key takeaway we had in March, and we had it again yesterday. You have to sometimes step back as a market participant and say, hang on a sec, if the data clearly is hot, if the inflation keeps coming in hot all the time, why is it that they are reluctant to be hawkish? Why are they not willing to just suddenly go again and hike when they're telling us that they will be determined to bring inflation back to 2%? And it comes down to risk management. Okay, central banks are not in the game of blowing up the economy. They're in the game of managing risks. And at this point, with interest rates at the highest they've been in 2 decades at 5.3%, the risk of hiking another 25 basis points, the implications of taking that risk are far more severe than just allowing a higher level of inflation in the immediate term. Okay, and that's the key takeaway. It's about balancing the risks for the central bank. It's not just a case of, oh, okay, PCE is sitting at 2.8% year over year. We have to act. Okay, that's not the game that central banks are involved in. They're in the game of managing risk. Now, what that means, and this is a key takeaway, if you've studied enough central banks, whether it's the BOE, the S&B, the ECB, the Fed, they will always err on the side of caution. In other words, they'll always be more dovish than more hawkish. Okay, because typically the response function or the reaction function is to safeguard things from blowing up. Right, so they will accept higher inflation so long as they don't blow things up. And that's a key thing to understand, because that's the communication the Fed's telling us. They're telling us, and this is what I want you to understand, we are one data point away potentially from beginning the cutting process. And this is what Powell said to us in March. He said, look, the January inflation print plus the February inflation print do not change our outlook. Okay, yesterday he said, sure, we've lost a bit of confidence, but ultimately they stand by the fact that they will begin the cutting process should they see demand suddenly start to drop off a cliff. In other words, and this is important, tomorrow's non-farm payrolls. If for whatever reason non-farm payrolls comes in at 4.1% tomorrow, don't think, because market participants will not be thinking. They will be jumping in, particularly to the interest rate sensitive 2-year, because they'll start the process of pricing in the rate cut cycle. All right, that's what you have to take away from the Fed. They are one very bad print away from beginning that cutting cycle. Okay, another example, we got CPI in 2 weeks' time. If the CPI misses for whatever reason, market participants aren't going to hang around and wait for Powell to communicate to them, because Powell's just going to come out and say, I told you so, it was seasonal, and our trend's intact, we're getting more confident again. And that's what I want to stress. Okay, we are one data point away from that cutting cycle beginning. Right now, the market thinks the cutting cycle starts September/December. Okay, now 2-year yields, a great product to trade. I stress every one of you to consider trading 2-year yields. Why? It's not necessarily that they provide or present the most tradable opportunities, but they do present fantastic fundamental understanding. Why? Because the 2 years linked very closely to interest rates. Now, what you would have come to understand over these last couple of webinars is that the 2-year yield directly impacts everything. It impacts the S&P 500, it impacts the gold, and this is what I'm going to show you now. Now, based off of yesterday, what you would have noticed is that the 2-year yield for the last, this is a daily chart, the 2-year yield for the last 3 weeks has gone nowhere. It sat between 4.95 and 5%. And it was waiting for the FOMC. And Powell said to us, look, we're not going higher, guys. Remember, the market's gone from 4.13% in the start of the year up to 5.05%, because the market's been pricing this idea that perhaps the Fed needs to go a little bit higher. Now, the market sat around this 5% for the last 3 weeks waiting. What did Powell tell us? He told us, we're going to begin the cutting process at some point this year. We just need more confidence. So we should start to see 2-year yields peel back down. Okay, go and have a look at the 2-year. It's a fantastic product. And like I said to you, the implications for the S&P 500 are very obvious. Okay, in the green, we've got the S&P 500. And what we've noticed is every time yields peel down and down, S&P can ultimately stage a rally and stage a rally. All right, if 2-year yields start to drop off, this in essence is the bottoming of the S&P, and we should see record highs within the next couple of weeks. Okay, now what's important for you to understand for gold in particular, it's a great market. It's a market in play. It's a market with a theme. The theme is simple. Chairman Powell, are you willing to accept higher inflation? Yes, I am. They've told us they'll allow inflation to get back to the target only in 2026. What that means is investors want to hedge against inflation. Okay. Equally, if you're a central bank saying, look, we're going to cut rates even before we get to our target, what you're in essence telling investors is that we're prioritizing the economy and full employment over inflation. So we'll accept hotter inflation. Now, gold is a hedge against inflation, which is why gold has rallied since the beginning of the year. Now, the key takeaway is it's not about nominal yields, it's about real yields. That's ultimately what drives the price of gold. And what's happened, think of Jan, Feb, March this year. Inflation's been coming out higher than expected. So ultimately, if we look at the equation for real yields, it's nominal rates minus inflation. So nominal rates, ultimately we'll get to that in a minute, but inflation has been moving higher. Nominal rates have been moving lower. Why? Because the Fed's told us they're going to be in the process of cutting rates. So in essence, real yields have dropped up. Okay, sure, in the green we have got two yields, and we can see that nominal yields have gone up, but ultimately real yields since the beginning of the year have fallen away. Why? Because inflation's starting to reaccelerate and the central bank was talking about rate cuts. Okay, now sure, if we look over the course of April, okay, real nominal yields went from 4.5% up to 5%. This was when we had the most dramatic move. What was the result? Gold topped out. Why? Well, because like I said, the moment those real yields started rallying at the start of April, gold said, hang on a sec. This means that central banks are getting serious again. This means conditions are not that loose. And as a result, we had quite a significant repricing in gold. We dropped $160. Now, however, what did Powell tell us yesterday? He said, guys, we're going to cut rates this year. Guys, we're going to accept higher level of inflation, which means he's in effect putting a cap on real yields. We should start to see those real yields pull back. As a result, we should see a bottoming out process in the gold market. Now, the BOJ, they've intervened, and you will notice on Monday, they drove the market 3.18% lower. Again, they intervened yesterday after the FOMC. Now, what I want you to take away from this chart is when they're intervening. They intervened specifically on Monday because it was a holiday in Japan. In other words, bad liquidity. They intervened. Why? Well, because if there's no one trading, it's very easy to move the market around, which is why they managed to spend 30 billion and move the market 3.19%. What did the market say? Sorry, Mr. BOJ, you're going to have to do a little bit more work than that. Okay, now that's important. Why? Because remember, the vigilantes are after the BOJ. They have an idea of how much reserves the BOJ has, and they are going to keep pushing the BOJ until the BOJ does what they don't want to do, which is hike interest rates. However, the BOJ came again. When did they come in? They came in after the FOMC, after the markets were shut. Why? Because there's not much liquidity. And again, they spent 3 hours, moved the market 3%, perhaps spent another 30 billion. What's the market starting to do? It started to say, no way. Now, this is important because you've got to keep a very close eye on this yen. Very clearly, 158 is the level the BOJ is going to keep trying to defend. So every time we get to it, get a chart up and get ready for that very aggressive 1 minute type price action. You want to learn to trade this, get a 1 minute chart up. Okay, go look at what the 1 minute chart looks like from last night, from Monday, and you'll see what it looks like. It's aggressive, it's full of volume, and it doesn't stop for 3 hours. This is key. Right? If you want to learn to trade these things, you got to get an understanding of the guy that's clicking the buy yen button. How is he doing it? What's the nature of how is he doing it? How many contracts is he doing? Because that'll give you an idea of how far he's willing to push it. Like I said, in both instances, he was willing to push it 3%, and he did it at a time when it was illiquid. So watch the 158 marker in the yen. You're going to see intervention there. Okay, now let's talk a little bit about how far the BOJ can go. The reality is that the BOJ's got a lot of reserves. Okay, that goes without saying. They've got 1.15 trillion in total reserves. And the thinking is that of that 1.15 trillion, they've got about 300 billion in liquid reserves so that they could effectively come in and prop up the yen. Now, what that means is if they're doing, roughly speaking, 30 billion every time they're intervening, they get about 10 shots, 10 bullets. They've used 2. Watch the market closely because the market's going to keep going to that 158. They're not going to stop. They're going to keep pushing because they know at some point that they're either going to beat the BOJ at the game or they're going to lose to the BOJ. But think about ultimately how much money can be made beating the BOJ at the game and running those reserves through. Okay, that's kind of the play that's going on with these vigilantes, and we call them vigilantes because it's someone gaming and taking on the BOJ. Right? Keep an eye on this. It's something that is going to keep developing. 158 is the key price level. Now, our second last chart is all about oil and the recession. Briefly speaking, the vertical lines are our recessions. Okay, these are the last, 1, 2, 3, 4 recessions we've had in essence, dating back to obviously 2008. Now, oil's a great proxy. Why? Because it's very much a leading indicator. Why? Well, if you go into a recession and people lose their jobs, they're not driving around. Okay? They don't have money to top up their cars. So it's a very quick leading indicator of consumer that's in trouble. All right. Now, if you go have a look, what ultimately happens in terms of sequencing? Remember, oil will typically always be in some form of a contango. That's kind of like a healthy oil market, sort of a contango of around 50 cents to $1. Again, don't hold me on those numbers. It depends. Okay. There's a lot of seasonal factors that drive it. But what you need to know is that typically in a recession, what happens is we start to see continuous inventory builds for an extended period of time. And that's what this purple line is. Okay, it's effectively the 4-week oil inventory average. And what we can see for almost the entire year, we've been holding a positive inventory build. In other words, a little bit more supply. Now, what typically happens is when we get a continuous oil inventory build and the market goes into a very aggressive contango, that is typically a signaling of a recession. Why? Because what it's saying is that there is so much oil that's currently available in the spot that nobody wants because no one's going to the petrol stations. That is typically a very, very strong signaling that we are already in a recession, not going into a recession. We're already in a recession. Okay. And what you'll typically see in the bottom here is you'll see the aggressive contangos. Okay, that's the bottom part. It's effectively just a 3-month, 1-month spread showing backwardation versus contango. Now, in terms of oil, we had a really big down day yesterday, but oil all year has been in backwardation. In other words, oil is showing quite a bit of tightness, and oil is showing that prices actually should be higher up on the year, which is why they are positive on the year. So right now, there's no fear of a recession coming from oil. We're still in backwardation. Finally, the wall of worry. Okay, we talk about this every single week. Over the last couple of weeks, there's been 4 things bothering the markets. Number one, higher rates. Like I said, 2-year yields, fantastic product to trade. We went from 4.1% to 5%. That's a headwind for equities. We had the strong dollar. That's a headwind for equities. We had the Middle East tension. That was a headwind for the equities. And we had earnings release on Q1. Now, the reality is earnings came in better. The Fed has come out and said they're still going to cut rates this year. The dollar ultimately, well, it's normalized. Sure, it's higher on the year, but it's higher because all the other central banks are cutting, and the Middle East tensions have effectively just disappeared. And what that means is the key risks for the market are all out of the way, and we can see that with the VIX in the bottom. We can see that the VIX is now sharply turning lower. We can see the average of the VIX over the last 10 days is back below 16, and we can see we're moving towards that average we've been for most of the year, which is around 14. And what that means is that we rallied because the environment was conducive for a rally. We had the pullback when the VIX spiked because there was those concerns. It forced profit taking. We seemingly found a bottom. We now should move and progress back up towards the upside. Finally, for the crypto guys, and I know I'm running close to the Q&A time, but very briefly, okay, we've talked about rebasing every single session. It's no different for cryptocurrencies. Okay, yes, you can trade Ethereum, you can trade BTC on the CME exchange. Great products to trade. What I want you to understand about cryptos is I don't want you to be sucked into narratives. I don't want you to be sucked into the social media, don't F this up, and don't, hodl to the moon. Don't be sucked into that. See cryptocurrencies for what they are. They're fantastic markets to trade, and they're very closely linked to the risk markets. And that's the purpose of this chart. What you can see here in the orange is Meta. Okay, they've been the best performing stock alongside Nvidia all year. And in the gray and the red, you can see Bitcoin and Ethereum. And in the blue, you can see the NASDAQ. Now, you can very closely see that the rally in cryptocurrencies was lagging that of Meta. Now, sure, Meta had blowout earnings, and they told us they're going to pay a dividend in essence in Feb. But the reality is that when Nvidia and Facebook began the rally and the NASDAQ began the rally, it was 1 or 2 weeks later before Ethereum and ultimately Bitcoin started to rally. And we can see that. We can see that Ethereum and Bitcoin actually went lower as the NASDAQ and Meta and Nvidia all started to rally. Okay. Cryptocurrencies are nothing other than a risk market. They're very closely linked to the risk markets. We can see as well once Meta topped out. It was the same time Nvidia topped out. It was the same time the Mag 7 topped out. The Teslas went down. At the same time, we saw the cryptocurrency start to roll over. The final thing, what should you be buying on rallies? Should you buy Bitcoin? Should you buy Ethereum? Well, what we can see this year is that Ethereum has effectively led Bitcoin to the upside. Okay, Ethereum has been star performer over Bitcoin. But what that means is on the way down, it's also been the massive underperformer. And that's what we can see in terms of the difference between the gray and the red line. It's the difference in percentage that Bitcoin and Ethereum are up this year. Okay, use rebasing charts, fantastic tools to really get an understanding of things. Finally, for career lessons, let's round up. The downside of getting lucky is that we tend to attribute the success more to skill than we do to randomness. Okay, you don't want to get lucky and make money because ultimately you're going to think you're good, and that's not good. When you start small. Keep your risk managed whilst you're paying to learn. If you learn to gamble with a small account, the reality is you're going to gamble with a big account. The only difference is you're going to lose a lot more. And then finally, only brutal honesty and accountability in decision making will allow you to progress. That is what the summary of all these 3 sessions has been. Be objective, be accountable to the decisions you make, and most importantly, adopt the skill of predetermined risk management. Mark, I'll hand over to you.
Thank you, Brannigan. And yeah, it was good. It was good stuff. I didn't really want to stop you in full flow there. There was one question from a kind of like macro kind of asset thing that I actually wanted to kind of address with you from the very first webinar. Was that you were talking about moving in from one asset class to another, from foreign exchange to bonds and equities and what have you. I was just wondering, kind of what kind of signals do you look at? What kind of thing will drive you to move out of an asset class or by the same token into one?
It's interesting you asked that question because actually one of the topics I was going to include today was how to know what market to trade. The short answer is I think you need to be versatile. I think you need to have one equity market, one bond market, and one commodity market. If you like currencies, fine, have it as a fourth. But there's a simple way I maneuver between them. So on my charts, I have something what we call average volume at time. Okay, and a simple way to think about it. I want to overcomplicate it. At any given point in time on a day, right now it's 1 o'clock London time, I know that the S&P typically at this point in time will have a certain amount of volume. And so what I look at is what is the current volume relative to what that typical amount of volume is. And if it's below, I'm not interested in trading the market. If it's above, I'm interested in trading, because what that tells me there's flows in the market, and flow means there's opportunity. Okay. Now, in terms of big picture, contextually, that's a day sort of how I determine on a day what market I'm going to be trading. In terms of sort of, moving or maneuvering from one market to another, what you can simply do is get 2 things up on a daily chart. Get volume up on a daily chart and get implied volatility, or just use a daily ATR. Okay, think of it as a daily range, the high minus the low of the day. How many prices is that? And when it's trending up, in other words, when the daily ranges are starting to increase or expand, that's when you want to be trading that market, because what that's telling you is the volatility is increasing. Equally, when it's going the other way, when we're starting to see volatility compress and ultimately price ranges become smaller, I don't want to trade those markets. I'm not interested in them because no one else is interested in them. Okay, and it's the same with volume. Volume just tells us participation. I want to trade markets where someone else is trading. I don't want to trade on my own, because if I'm trading on my own, who am I trading with? I'm trading with the algorithms. Okay, equally, the algorithms are not the ones that take markets from A to B. The algorithms just simply take the market from liquidity to liquidity. That's their job. It's the big institutional players that will ultimately derive where price goes next. And if you want to see what those big institutional players look like, just watch the volume. It will tell you when they're trading. So that's a baseline how it gets done. Mark, so hopefully that answers the question of how you navigate between the different markets.
Yeah, no, brilliant. We've had one question into there. Geopolitical news aside, are you bullish or bearish gold at these levels given last night's Fed comments?
Yeah, I think I was hoping that would come across in today's session, but I'm very much bullish. I think the thesis for gold all year has been inflation hedge. I have very openly said to a lot of the guys on the floor, I think the one risk for gold is if central banks do turn hawkish on inflation again. In other words, if they do prioritize inflation above the economy. They didn't do it last night. Powell didn't do it. He pushed back. He said, look, we've got a dual mandate. We think inflation will come down all on its own. So right now, we're just going to keep rates where they are, higher for longer. Now, what that means ultimately for gold is there is still a risk that inflation continues the recent trend higher. And so that means hedging for higher inflation is still very much a risk. Now, one thing I would say, and this is key, this is like, if you're asking me short term today, tomorrow, next week, what is going to be the key determinant about if this is a low or not is what that 2-year yield does. Okay, it's really, really battled. Like I showed you on the chart, 2-year yields have battled to get above 5%. Why? Well, because no one wants to ultimately go and sell the bonds at 5% yield because they're concerned that the Fed's going to cut rates. Again, that was squashed yesterday. I suspect that 2-year yield should start to come back. If it pulls back today to 490 and then 485, that's very much a green light for gold to the upside. Okay, the thesis remains, the trend remains. If that 2-year yield starts to pay back, I think that's the signal to be long gold again.
Okay, good stuff. Thank you very much. All right, well, I think we're kind of reaching the end now, so I'd just like to thank you again for this and the other two webinars that you've done. It's been an absolute pleasure having you on. Next time you're in the vicinity, please give us a call, and we'll stick you in front of a stand, and you can we can do this in person perhaps. But anyway, thanks again. Thanks very much for everyone that's joined us. Thanks to the CME for partnering, and just like to leave with our APM's SEO Nick to just have some final words. Thank you.
Yeah, thanks, Mark. Thanks, Brannigan. Yeah, big thanks to Brannigan. Big thanks to the CME group. We are going to have a seminar in 2 weeks' time, so watch this space. We will be putting details and notifications out very, very soon, along with subject matter and venue. So obviously it's going to be limited spaces. So once you see it, please kind of get yourself registered as soon as possible. So once again, thanks Brannigan, thanks to CME Group, and thank you everybody who has attended, either today or part of the series or the whole series. I hope you've all found it beneficial. Thank you very much. Have a great afternoon, everyone.
Great. Okay. Well, I think I'll make a start now. I'll just do some introductions. I think a few people are joining here just as we speak.